Time to take the gloves off in tonight's Times Square takedown. We are battling over the future of Tesla and the EV explosion. Our bear, the one and only fit and fighting trim Dan Nathan, future fund managing partner Gary Black, who joins us on the fast line tonight. We had some technical issues with this picture. Gary, you'll get the first swing here. You still like the stock here? You know, a lot of people were commenting on the conference call that Elon sounded really down and out. He blamed everything under the sun, higher interest rates, a bad macro environment, geopolitical. But this is still your second largest position.
Yeah, look, the conference call was lousy. The earnings were lousy because they missed on the most important metric, which is auto gross margin. And the quality of the earnings were light because it was all based on reg credits and lower tax rate. But when you think about the stock, it's trading now at 52 times. It's growing its volumes and earnings at 35% between now and 2027. I'm a growth manager. I can't find stocks that trade at 52 times that are growing at 30 to 35%. So we still like it.
In terms of volumes, you had noted on Twitter, Gary, that past price cuts didn't yield an increase in volume, and there's concern now that Tesla will continue cutting price in order to compensate for higher rates, which would hit the consumer in the form of the auto loan, auto financing. So, you know, to what end do they cut price at this point if you say that the incremental volume is just not materializing?
Yeah, there's been no demand elasticity, despite what Elon says. You know, if you look at where the estimates for 2023 were at the beginning of the year, and then you look at where they are today, they're exactly the same. If you go out to 2024, they're actually lower. So you're not getting any volume growth for these price cuts. So we've been advocating stop cutting price, put some money into advertising, use that as another tool in your marketing toolkit to try to get more volume. Because I don't think by cutting the price of the Model Y from 50,000 to 48,000 is going to get you any more incremental volume. And I'll go so far as to say that if you look at monthly payments of a Model Y today, if you took out a 5-year auto loan and rates have gone from 4% to, let's say, 7.5%, but the price of the Model Y has come down by 20%, the payments are actually lower today than they were a year and a half to 2 years ago. So I don't understand the logic of why they have to keep cutting the price. And look, I think at the end of the day, they're going to see that they're not getting any demand elasticity, despite what they said on the conference call last night. So we think that there might be another couple of price cuts, and we may see margins come down a little bit more. But I go back to, I got a stock trading at 52 times next year's earnings, growing at 35% a year, and I can't find stocks that trade at a PEG of 1.5 in the growth universe.
Right, but Gary, you know, that revenue growth is decelerating, right? The delivery growth is decelerating. And I remember listening to you, I think it was on the last call in April after the Q1 earnings report. And I remember, I think you said that you sold a part of your position. You were not happy with the price cuts. That was all the way back in April. And if I look at this stock and I look at now the three reactions the day after it's reported, it's Q1, it's Q2, and it's Q3, it sold off basically 10% each time. So the big money out there is selling on those days. You seem to be very frustrated with his strategy. You seem to not buy the math that he's giving, you know, and the CFO, you know, who does all the math, right? Like, he left a couple months ago without really a statement or anything like that. So maybe there's some funny math going. And I listened to the same call that you listened to, and I give you a lot of credit. I was reading your Twitter this morning. You were being very honest about it. Are you selling, if you were selling stock after the Q1 call when the stock was $175, are you selling stock here at $220? Because it looks like the fundamentals of this company, at least as it relates to the autos, are deteriorating. And if simple math about price elasticity is not working for this company right now, why are you sticking around waiting for that growth to decelerate further if that's the case? And we haven't even had the recession yet, okay? So that's the other point I would make.
Yeah, well, we got a couple catalysts ahead. So, one, the Cybertruck is going to be huge. If you go out and you talk to pickup truck owners, and you got to talk to all of them. You can't just talk to 65-year-olds who drive F-150s. You talk to 30-year-olds, 40-year-olds. We go out and we do that. What you find is people love the look of the Cybertruck. The Cybertruck will be out in about 2 weeks. It's going to be a rolling billboard, and you're going to see it, and you're going to get excited about it. And you may not buy a pickup truck, but you're going to go to the Tesla website. You say, wow, that's really neat. What is it? I can't even imagine the social media buzz that you're going to get when that Cybertruck starts rolling all across America. And there's a halo effect that will come with that. That'll ignite the entire franchise. That's one. Two, they didn't talk about this. I'm not sure why, but there will be at some point an FSD licensing deal with another OEM. It's probably going to be like a Toyota or a Honda, and that's going to get people very excited because there's going to be other FSD licensing deals. And then the third thing is that the energy business, which has always been very small, is now the highest margin business. It's 24% margins. The auto business is 16%. That thing tripled in the third quarter versus the third quarter a year ago, and people aren't putting any value whatsoever on that. So I think there's a bunch of catalysts ahead. And then the $7,500 IRA credit is going to go to off invoice January 1st. So I got a lot of catalysts, and you're right. The volumes have been decelerating. We're probably, if they hit 1.8 million for the year, that means that their volume growth for the fourth quarter is only going to be 18%. But I think they can get back to 30%.